Big tech earnings season will shift into fifth gear next week, with giants like Apple, Microsoft, Amazon and Alphabet reporting second quarter earnings over the course of the week. But tech earnings may well be eclipsed by another major event for the stock market: the Federal Reserve's next move on interest rates. Before we get into the news, I would like to welcome you to my channel. On this channel we look at the latest news surrounding the latest stock news. I would like to announce a giveaway I will be hosting. I will be giving away a $50 Amazon gift card, and all you have to do is subscribe and like the video, and make sure you watch till the end of the video. Now let's get into the news. A look at sentiment indicators suggests that Americans are eyeing the rate decision by the Fed more closely than upcoming tech earnings, and that makes sense, wrote Peter C. Earle, economist at the American Institute for Economic Research. Inflation is hitting Main Street very hard right now. Rising interest rates have been a main focus for investors since early this year, when the Fed embarked on an aggressive plan to tighten monetary supply in the face of rising inflation. June's inflation data came in hotter than expected, prompting analysts to predict that the Fed could raise the federal funds rate by at least 0.75% and as much as 1% at the end of its July meeting next Wednesday. A 1% increase would be the biggest interest rate hike since the 1980s and would heighten concerns that the economy could dip into a recession. If they come in with a 75 basis point hike as we expect, but soften the language about future hikes, it would be a huge boost to markets next week, said Luke Tilley, chief economist at Wilmington Trust. For some experts, however, the Fed's decision may actually take a backseat to tech earnings. FANG earnings, along with Microsoft, will be front and center for investors to give some better direction clarity on the overall demand environment in this shaky macro, with the tech sector already slowing hiring across the board, said Wedbush analyst Daniel Ives. The reports will be an important barometer to better gauge the health of consumer demand amid a softening macroeconomic environment, Ives added. Moreover, the Fed's interest rate hike already seems to be priced in by the market, said Nancy Tengler, chief executive and chief investment officer of Laffer Tengler Investments. The stock and bond market already have responded to the Fed's cautionary rhetoric over the past few months, repricing accordingly, she added. That leaves little room for the Fed to surprise the stock market on Wednesday, said Jan Salagi, CEO of research firm Toggle AI. Tech companies, in turn, can still turn in quite a few negative surprises, mostly because it takes a while before analysts lower their expectations, he said. The focus will be more on individual stock performance, Salagi added. Ives believes the two most important tech prints next week will be Microsoft and Apple, given that the companies have weathered the economic storm relatively well so far, compared with the rest of the sector. Tengler agreed, saying this is the kind of market where investors should focus on industry leaders with strong free cash flow and dividend growers. She and her firm, Laffer Tengler, own both Apple and Microsoft, seeing the latter as a good way to bet on cloud and cybersecurity exposure in the long run. To be sure, Apple and Microsoft are crucial to the earnings picture, Tilley said, but if they meet expectations and offer cautious guidance, they join a large camp of multinationals that have already expressed similar sentiment, he added. Whatever the case, it's shaping up to a whirlwind week. Investors, brace yourselves. Apple is set to report earnings this week against a backdrop of an economic downturn and a plan to slow hiring. Also, the company pitches itself as a health tech leader, and we have more details on the upcoming high-end Apple Watch. Last week in Power On, Apple's new iPad Stage Manager multitasking feature doesn't replace the need for a Mac-like approach. The economy is catching up with Apple. For the first time in a while, the company seems to be vulnerable to outside factors like rising inflation, increasing interest rates, the surging US dollar and the threat of a recession. I reported this past week that Apple plans to slow spending and hiring across some teams next year in anticipation of an economic slump. Later this week, the company will report its fiscal third quarter sales, which most analysts anticipate will be roughly flat with last year. Apple also continues to see some kinks in its supply chain, which may limit availability of some of its next devices. As part of the hiring slowdown, Apple won't fill some roles when employees leave and will keep headcount flat for certain teams. The company isn't going as far as some tech peers, such as Tesla Incorporated, Meta Platforms Incorporated and Microsoft Corporation, which have announced job cuts. Apple is avoiding layoffs and, thus far, isn't issuing a public statement on its plans. But I would anticipate that Apple will hint at the move during Thursday's earnings call with analysts. The results themselves are expected to show a major deceleration in sales growth. Analysts predict that revenue will climb by about 2% from a year earlier, the slowest pace since 2020. Compare that with the 36% jump that Apple saw in the third quarter of 2021. Revenue is expected to come in around $82.7 billion. The iPhone will account for a little under half of that, analysts predict, with services generating nearly $20 billion. Apple's challenges go beyond the latest economic concerns. First, the company already said you can shave $4 billion to $8 billion off the top of last quarter because of supply problems stemming from Chinese lockdowns and the chip shortage. Second, it's a tough comparison. The third quarter of 2021 included a lot of pandemic-induced spending by people outfitting their home offices. That led to a nice jump in Mac and iPad sales. Third, though the latest MacBook Air was announced during the third quarter, it wasn't released until the fourth quarter. Many customers held off buying a MacBook Air, Apple's most popular Mac, while they waited for the new model to arrive. And, yes, there's the economy. Given all the uncertainty, more people are probably holding on to their cash right now instead of spending on new Apple products. If they do splurge on technology, they may wait for the latest iPhone, AirPods Pro, Apple Watch and iPad to arrive this fall. If the economy does take a dive, it's only going to get harder. These factors have already led Morgan Stanley, Wells Fargo and other banks to cut their stock price targets for Apple by about $10 a share. I still think Apple will be able to bounce back fairly quickly. Make sure you do not forget to turn on notifications by pressing the bell icon so you do not miss the latest news surrounding the latest stock news.